Hello, everyone. This is your host, Carlos Cabrera for Fintech Today. I'm very excited about our guest today. He is very well known. His name is Frank Kaberna. He's the head of content at the Small Exchange. He's been at the Small Exchange for over 2 years, and also he's a content producer at Tasty Trade, and he has experience as futures trader in at the CBOE. He was at it for over a year, and he holds a bachelor from the University of Michigan in mathematics and risk management. Welcome, Frank. So excited to have you.
Carlos, I'm so excited to be here, my friend. This is going to be an absolute ball today. We're going to have a bunch of fun talking about futures, options, other derivatives in the space, what the small exchanges offering, this young upstart futures exchange that launched about a year ago, competing with the CME and everybody else. We're going to have a ton of fun talking about the products, that battle with larger other exchanges, and maybe a little bit about myself, I guess, to start. Yeah, I came out of school having studied mathematics, went straight to the Chicago Board of Trade. I prop traded at night, U.S. interest rates, the futures, the cash products, the spreads between all of those euro dollars, treasuries, so many different things. And I had enough of it, Carlos. After a year, I was done. Waking up at 2 in the afternoon and going to bed at 7 in the morning was not for me, trading Asia and Europe. So I jumped on over to Tasty Trade, started writing a bunch of futures and options content for Tom Sosnoff, Tony Batista, and the main Tasty Trade live show there in the morning. And since then, I've cultivated my own personality as the futures guy among a bunch of options men and women there at Tasty Trade, and jumped on this really exciting new project, the Small Exchange, which is now actually, as of I believe it was maybe last month or the month before, has been trading futures contracts in the space for over a year. We just hit our millionth contract traded a couple months ago, so we're really excited here, and we'll dig into it, I'm sure, as we progress through what's about to be an amazing episode of FinTech Today.
Yeah, that's one of the things that I find when I talk to anyone about futures and options is that I would say that for our listeners and for people to get to know more about the small exchange, what do you, in your view, how would you define the difference between futures and options so that we can all learn from that and start clear?
I think it's a great spot to kick the ball off rolling here today because it's a funny thing to me. Like I say, I came out of school trading futures and I had to read a lot of white papers and a lot of like just really boring stuff on the Chicago Mercantile Exchange's website. That's the CME, very popular futures exchange for the last several decades. And not a lot of stuff, content that is focused for the everyday person. Like I was, a professional trader trading for a proprietary trading group at the Chicago Board of Trade every night. And even I was having difficulty understanding this futures stuff. And I've obviously, through the past, 5 or 6 years being in the space, have got a good handle on it. But what's funny, Carlos, is that so many people understand options, calls and puts, strangles, iron condors, all this different stuff. And that stuff, in my mind now, is so much more complex than futures. Options and futures, they're kind of like brother and sister in the derivative space, whereby, you've got stock shares, you've got ETF shares, you've got cash, crude oil, cash foreign exchange, and all this other stuff. Options and futures are, like I say, siblings in the space. And futures, in my mind at least, is like the simpler sibling. Not to say the the worse or better one, but it's simpler. If you think the thing's going to go up, you buy it. If you think it's going lower, you sell it. And I don't know what it is that trips people up, and myself included. Like I say, it took me months and months to understand, what futures really were and feel comfortable in that world. But if you can understand, stock is at 100 and I sell the 105 call and I know what I want to happen in the market, man, once futures click with you, it's going to be a real easy thing to pick up. Because yeah, like I say, it's like it's essentially this simpler version of options in this derivative space, whereby you really have two outcomes, which is buy or sell, and then the thing goes up or down, hopefully in your favor.
That's a good rationale, and usually what the typical concern or comment that people make when when I address the futures and people's opinions about it is that the leverage. So say,
Yeah.
what do you think is the average leverage of a standard SPY futures contract, or any of the main ones?
So let's, I guess, I'll start from the beginning on this in
Mhm.
terms of leverage, and we'll kind of ease our way into that idea. So one of the greatest pros of futures, but also has gotten a negative connotation over the years with this idea of leverage and added risk. One of those greatest pros is when you buy a futures contract, say on the S&P 500 or on corn or some commodity, crude oil, whatever, you are in theory buying the right to buy that thing at a future date. So you have the exposure to that S&P 500, but you don't have to put forth all of the money to actually own those 500 stocks here today. Now, with that idea in mind, you are afforded a great amount of just lower cost and cost effective capital usage with these futures contracts. The S&P 500 example, looking into that right now, you have to post around 10% of the S&P 500's worth to buy those 500 stocks. Now it fluctuates, and that's, by the way, called the margin that you have to post, or the buying power. I know is another term that has become ubiquitous across the space. Um, and so essentially, if I want to buy the S&P 500 ETF, I want to buy some shares of it, and say I want to buy $1,000 worth of the S&P 500 ETF, I have to put up 50% or 100% of that value, which would be 500 bucks or $1,000. And a lot of places it is 100%, which kind of makes sense. It's like, if I want to own a share of Apple, then I need to buy that whole share of Apple. What's nice about futures is you can buy the futures contract on those shares on that stock index, and you have the exposure of, say, that $1,000 worth of the S&P 500, but I only have to put up 100 bucks, which is a great tool for small investors, small traders, because now you can say, okay, maybe I only had $1,000. I only have to put up 100 to get 1,000 in equity exposure. I can go diversify and hedge in other spaces now with the $900 that's in my account. Now, Carlos, the negative connotation rightfully comes from the last 20, 30 years of everyday people starting to become comfortable in the derivative space, but using these institutional products like the E-mini S&P 500, for instance. That's a product that's over $200,000. Okay. And so when that thing moves, even if you have enough money to post the margin for that, which is, via the math that we just did, about $20,000, that thing is going to move a lot on a daily basis. And that amount, that it's not the amount of leverage, because it's the same from, if the product's $200,000 or $20,000 or $2,000, you're going to post the same rate. But when you're trading a product that's that large and it starts to move a little bit, that leverage really swings your account. And that's when people get too highly levered and problems arise, especially also in the crude oil market is another similar one, where that thing can really move. And if I don't understand that this is a product that is 10 times what I'm posting to trade it, then I can really feel uncomfortable real quick. But we always talk to people about, taking those savings from, in that example, I've got $900 on my hands. I'm not going to go out there and buy 9 more futures on stocks. What I'm going to go in and do is maybe sell a call here, or buy some bonds, something that is, inversely correlated and can give me some diversification, or some gold or something else. And just give yourself more tools for diversification and future growth, as opposed to, having to put up that $100. Oh, now I'm just going to do it 10 times.
Exactly. So it's all about balance, and definitely uh, touching upon the leverage side. It's very important because getting those margin calls is it's not a fun place to be.
It's one of the worst places. As someone who's been in that situation a lot, it's one of the worst places to be. And we always talk about the best way to learn with all this stuff is to not read those long white papers that I like I said, I read several times to get anything remotely down in my head about futures. The best way to learn often is going in there and buying and selling a future, or the first time you traded, options or anything like that. It's like, oh, I went to this like really cheap call spread or put spread. I bought it, felt what it felt like to have it in my account, and then I got rid of it for $1 or two loser. Now the problem becomes, Carlos, when you do that with those E-mini S&Ps or those crude oil futures or the gold futures that are also close to $200,000 in size. You can't test that out. You can't learn with something that moves hundreds of dollars every second. So yeah, to me, the learning process with this stuff is like any other product that's out there, but futures do get a bad rep because those historically, large futures products that, I mean, it's not to shame the CME or ICE or any of these other exchanges. They created those products for large institutions. But what's been really nice in the last couple of years here, as people get more comfortable with options and with just the idea of managing their own money, they want that cost effectiveness. They want that futures access in their account. But when you try to do that with these products that were made for banks and big farming companies to hedge their, billions of dollars on the books there, it's going to be an uncomfortable situation real quick.
Yeah, and a lot of times, do you think that the game has changed in terms of when people talk about futures, I would say that a lot of times they are concerned about the standard contract time and and the returns. Is there like what is the standard contract time for someone that's getting started into futures? You know that in options, for instance, you go 60 days out, you could go 120 days out.
Mhm.
So how can someone that has say 5 years of experience in future or regular equities, when they get started, what is your advice in terms of the timing they should deploy?
Sure. So yeah, this is once again, and this will become a common theme, hopefully. This is a relatively simple answer. Like, your brokerage, first of all, when you search any future, if you search, ES, the E-mini S&P, they're going to almost always send you straight to what's called the active contract. You always want to be trading what's determined as the active contract or the active month. And now, what deems that? I mean, there are futures that the next expiration is December. That's months down the line. There are futures that the next expiration is September, is this week. How do I determine which is the active and which isn't, if my brokerage isn't sending me there, or just, for your own knowledge, what is the active month? And here's the simple thing. Here's what's really nice about it. It's the one with the most volume. You want to be trading the futures contract that has the most volume. It's similar when you open up a trade page for options, and you see, a bunch of beautiful strikes in the expiration that you've opened there. And you see, 90% of them have traded 4, 5, 6 contracts, but you see those big round numbers like 100, 105, 110. Those have traded, 3,000, 4,000, 5,000. It's the same with futures where it's like, man, I don't want to be getting in and out of the futures contracts that have, 5 to 10 in volume and are 10 ticks wide. I want to be in the one that's got a few hundred, a few thousand in volume and are 1 or 2 ticks wide. And you can find that, like I say, pretty quickly there if your brokerage doesn't send you immediately there. What's really nice, Carlos, about these platforms and these brokerages, one, they're really smart. Two, they really want you to engage with products, and so they'll hopefully send you straight to where you should be headed, as long as like I know for Tastyworks, that's a popular active trading platform. It's the forward slash, so it'd be forward slash ES, and then it'll fill in the month code that you want to go to that would be deemed the active month. Or for a small exchange product like our small stock market, forward slash SM75, it'll fill out the rest and send you where you need to be. And yeah, it's a good question with like days to expiration. Where should I be in terms of that? I would say the only thing to worry about relative to days, like I say, most of the time it's going to be like just go where the greatest volume is, where the tightest bid offer is. Because some of these like euro dollars, for instance, they have expirations going out the next decade, 4 times a year for the next decade. Could you imagine being new and trying to figure out what the heck to do with that? But the only thing I'll say with days to expiration, you don't want to be in a futures contract that has 2 or 3 or 4 days to expiration, and that's leading to when you want to roll that thing to the next month. Because a lot of people, futures, Carlos, primarily for the active trader, the day trader, someone who wants to channel that cost efficiency, that leverage for better or worse into making money in the next 5 minutes, the next 10 minutes, the next couple of hours. But a lot of people have found great success in investing in these futures too, and that's when the roll comes in. So hopefully, if you're trading actively, you don't have to deal with roll. You usually don't have to deal with expiration because you just go, it's Tuesday afternoon, crude oil's moving. I type in crude oil and it brings me straight to the active month, and I'm in and out hopefully in the next couple of hours here. But yeah, for those of you using futures to invest just with greater cost effectiveness and creating greater potential returns in the future, you want to make sure you roll that thing with it at worst 1 or 2 days to expiration.
Awesome. That's definitely useful. And I know that when people talk about futures, I'm sure that our listeners, one of the things they want to know is are the returns? A lot of people talk about huge returns. Some of them are also concerned about the risks. So, what's in your experience? What should be the logical expectation between when someone goes into the futures? Should they expect returns of say 10%, 50%, 200%?
So this is a great question. I'm glad that you posed it the way that you did. I feel, Carlos, like we're really starting to break the ice here because I want you to ask me anything about futures that like are the everyday trader, the new person to futures, like what are your qualms? Like what are the things that you're kind of worried about getting into this space? Because at the small exchange, especially, we have absolutely nothing to hide. We make products that our smallest product, Carlos, is a total size of $200. Like you'd have to have a really small account for that thing to blow you out. We want to create, a customer base that is totally comfortable and is not taking on too much leverage. But then on the flip side of that coin, we are the last people who are gonna, post a YouTube video that says, "Here's how we made, $5,000 in 10 minutes." It's ridiculous. It's not sustainable, and that same person probably dumped 10 grand the next week. Like it's absolutely ridiculous to kind of think like that. Now I can absolutely give you realistic expectations based on the math behind margining in futures. So let's have a little bit and stop me when I've gone too far, because I will
Oh,
definitely go to, yeah, be ready to stop me because I will go too far with some of this math here. But essentially, the margin that you put up on any product is going to be an extremely competitive number that essentially tells you how much the product moves. So what'll happen is, if you're trading stock indexes right now, uh, given volatility in the stock market, it's not very high. The margin rate for a stock product that's $10, a stock product that's $10,000 is around 8 to 10%. Okay. And so if stocks really start to move, like when the pandemic kicked in February, March of last year, and stocks slid 20, 30%, some of those stock indices, margin rates went up, right? It's a function of volatility there. And now, when you're trading something like crude oil, or you're trading Bitcoin futures, new in the space, um, those margin rates are going to be higher. That crude oil is a market right now around $70. In the last month, it has risen by more than 10% and fallen by 10%. And so that's a lot more movement than stocks. Your margin rate in crude oil right now is going to be, 15 to 20%. You go to the other side of this, and also Bitcoin futures, I think it's actually at 50% or even greater. Yeah, I don't even know if you get leverage given how much that space moves. You go in the other direction. You go to foreign exchange products, Carlos, like our US dollar at the small exchange. The margin you put up is actually 1% of that product size, just because foreign exchange doesn't move that much, man. And so what you're going to get is dynamic margin rates. But what I found in my research, a ton of data points across a lot of asset classes, metals, energy, equity indices, interest rates, and foreign exchange. What I found, Carlos, is that on a daily basis, the way that these margins are calculated, the product is likely to move, give or take, about 20% of that margin rate. So, what I can kind of do with back of the envelope math is say to myself, okay, if this product is requiring that I post, I mean, a pretty standard future at the small exchange is a product that's a couple $1,000 that requires that you put up like a couple $100 in margin. So, say I have to put up $300 in margin. What would be a really realistic return on that given day would be 10%, given that the market is going to move probably 20% of that margin. So if I put up $300 with that 20% number, I know this market is likely to move today about $60. Okay. That's 20% of my margin. And so, what can I realistically clip from that movement in a day? Probably, a quarter or half of that. So I could potentially return 5 to 10% trading intraday. Now, of course, that margin is a great, great, great number to keep in mind for how much that market is likely to move between now and expiration. So if I'm holding for multiple days, or maybe I'm holding toward expiration, or at least up to that, and maybe I'll even roll and hold longer if I need to, then that's when returns get closer to probably the potential for 100% return, and the potential to lose that $300 if it goes against you in that example given. I mean, does that, now, of course, the the sensationalist articles that you'll read or YouTube videos that you'll watch will be like, oh, I made 5,000%. Now, yes, that can happen. Of course, it can go against you in that way as well. But that would essentially be, Carlos, like that the start of the pandemic there, when stocks in certain days dropped 10%. If I have to, post to sell a stock index, less than 10%, then I could theoretically on that day have made more than 100% just trading intraday. So, of course, those outliers exist. You do have the potential to make or lose greater than 100% when you're trading futures. But when you're day trading and you're getting the feel of things, especially with small exchange products, it's a matter of like, oh, I can make $50, and that's a nice like 10%, 20% return relative to the money I posted.
that's very true. I was just going to actually go over that. I mean, 5% intraday, what you're suggesting, 5 to 10%. That's a very good return compared to what someone can get out there on, say, if they just leave their money, say, at a in a savings account or money market account. So
Absolutely.
they
And you know, another thing toward that point is like there are so many I love to see this community grow, and I've loved to be a part of it the last 5 years of just like everyday people not just buying and selling shares of stock, you know, not just because of course the easiest thing you could do is download Robin. And not to say it's a negative thing, it's a great first step. It's a great first step, which is you download Robinhood or something else and you just park your cash into SPY shares or
right,
whatever. It is the first thing I tell anyone who wants to get into this, you know, that's the first step. And then once you kind of catch the bug and yearn for something more active, you get into that option space. And then the next step is kind of this futures. Because what stinks about options is like you do get some of that leverage, you know, when you're selling calls or you're buying puts and everything else. But you have pattern day trading rules that keep me from, you know, taking winners, taking gains or losses on something that's really moving around in the stock market. Or maybe I wanted to trade the non-farm payrolls or the FOMC event, and I wanted to open a position going into it and close it afterwards. I'm going to get dinged for that pattern day trading there. You
right.
don't get that with futures. It's actually you get afforded greater leverage and less margin if you put on a position and take it off intraday. They actually promote that, which is a good thing, I think, because you're reducing risk, right? Like that's my whole thing with trading futures and looking for, you know, those 3, 4, 5 to 10% returns intraday. It's a new type of trade, and it also promotes not having to take risk going into the night when you go to sleep, when you go eat, when you finally turn off your screens. And the futures margining knows that. It's so smart that it will actually give you an even smaller rate to trade stuff intraday. So it's definitely kind of that next step beyond options, but a lot of advantages, both return wise and like I say, with regulations on pattern day trading or trying to sell hard to borrow stocks. You have no problem with that. The same margin to buy and sell every single market in futures.
That's a great point. And I would say that for the active trader, that's one of the things that it's a main difference between, say, the futures market trading using, say, at a small exchange, and using just doing regular trading at, say, Robinhood, like you said.
Yeah.
It's very different in terms of the pattern day trading. And do you feel that this pandemic environment that we are, I hope, almost done with, has changed the futures market? Has it affected in some ways the
Yeah, I absolutely would say so. And it's one of those things that has not only affected futures, but affected the industry at large. I agree with you. Obviously, I don't know who wouldn't agree. Like, I hope that we are nearing the end of this thing, and I know, thankfully, with vaccinations and everything, we've been able to get more comfortable and start to do things again. But what's been I mean, fortunately for our company, but unfortunately for so many. So I hate to even kind of reference it, but like everybody was stuck at home, Carlos.
Mhm.
And when people were stuck at home and the market was moving, a lot of people were like, hey, I'm going to look into this thing. And so brokerages had record account openings, of course. It just, and it makes sense, right? Like people who are, you know, sheltering in place and, you know, you can't go out to dinner, do any of these things. You have if thankfully if your, you know, work is still able to make it through the pandemic, you have these paychecks coming in, you're not spending on all these different things. And it's like, man, I just finished my work, what should I do? Oh, I have to sit here, I've already watched everything on Hulu and Netflix. Let me look into this trading thing. Everybody's talking about, you know, the stock market's sinking here, Bitcoin is moving around. Let me figure this out. And so there was just a general broad push by a lot of people to, open accounts at different brokerages, try to give their take on investing. And thus that bleeds over into the derivative space. A lot of people in the last year and a half have become acquainted with options. They've taught themselves it, or they've learned it using great resources like Tasty Trade and everything else. And the small exchange, um, we launched right after the pandemic kicked in, which was not necessarily advantageous to be separate when you're trying to launch a futures exchange. But the nice silver lining for us was that a lot of people were looking for futures content, futures education. How can I do this thing here that we're talking about right now, Carlos, which is like day trading? I can't really do it with stock shares. And if I do it with stock shares, I'd be lucky to make 0.5% given all the money that I have to put up there. That's not exciting or really making it worth my while to get active. And so it was nice to have that that push towards more active trading. But what we found, and why I think it's taking people so long to go from stocks and ETFs to futures, they're even more likely to go to options, is because these old futures exchanges have never cared about the random person who's sitting around during the pandemic who's got, $5,000 to trade, or 10,000, or even less, a couple $1,000, a couple hundred. It's not worth their while. And so the education isn't out there. Like I spoke to at the beginning, like, you have to go read these white papers that were made for professionals at banks or at, production sites for agricultural firms and all this other stuff. It doesn't make sense to, Frank sitting here in Chicago, or anyone else, hanging around on the East Coast, West Coast, or anywhere on the planet who's trying to figure out this futures thing so that they can get active and make day trades and profit from short-term action. And so what the small exchanges really work to do, and hey, I mean, we're even doing it as soon as I believe it's September 22nd. We're hosting, a YouTube live stream, futures trading for beginners. We're creating a ton of stuff at the small exchange website that's just like free educational stuff, bringing people on board to understanding futures. Because honestly, like, the options trading world and the stock and options brokerages, they went miles during this pandemic, just because all of the infrastructure was built. Tasty Trade was started a decade ago, Carlos, and they absolutely lifted off in the last 2 years because they had all of this content, all of this education built, ready for people to be like, oh yeah, now I'll look into options. And then boom, it takes off. But futures have just not been there. And what's really exciting is that not only is a small exchange, created for this everyday person to have a better experience with futures, get better educated on what these futures have to offer before making their first trade. We've pushed significantly. We've pushed the CME and some of these other exchanges as well. It's funny. We launched recently a small crude oil product, because crude oil is one of those that I keep referencing because the traditional products way too big for you and me. Like,
Right.
these things move $3,000-4,000 on a daily basis. The day that we launched our product that is a tenth the size and moves just about $100 on a given day, Carlos, CME announces they're launching a smaller product on crude oil, which, like, of course you'd be like, oh man, like, they're a big company, they're going to wipe you out. We love to see it just because that means that these people are hearing us as a company and general traders and investors in the space who are saying, hey man, like, we want to use these futures that have always been excluded to us for institutions. And so they came out with just a month ago interest rate products that are, I kid you not, they look exactly the same as the futures on interest rates that we launched back in December, man. So